A PhD in retirement planning? You got to be kidding me. I had no idea this was possible. And we've got a guest on our podcast today who's going to help us buy the best boring money there is. Here we go. In the studio with us today for our podcast at the Cash Compound, we have got Dr. Tom Wall, ladies and gentlemen. We're going to talk a little bit about what he does, what he knows, and what most people completely misunderstand. And Dr. Wall, so happy to have you on the podcast, my friend. Welcome.
Jeremiah, so good to be with you.
Yes, sir.
Appreciate you having me.
Yeah, man. I'm really excited because we met just a couple of months ago, the summer of 2023, and we were in Denver. We both had a little bit of a speaking moment on the docket at the Better Wealth and the And Asset Mastermind Conference. And I was blown away with your work because you're the kind of academic that can prove what we do works for everybody. Tell us a little bit about yourself, man, and your background.
Yeah, I appreciate you having me. Thanks for the kind words. You know, I've been in the business now 20 years. I started 20 years ago as a college intern, selling life insurance for one of the big mutuals. And spent about 4 years as an advisor before moving my way through various home office roles at other, big mutuals along the way, becoming along the way basically a life insurance expert, positioning whole life insurance and competing against its alternatives. And then, toward the end, got into the marketing realm and really, a couple of years ago, wanted to get back out into the world and share what I had learned through all my studies and all my time in front of thousands of advisors. In a way that was, consumable by the average investor, so that, people can have better retirement outcomes.
Love it, man. So here's the question I have first, before we get into those numbers and, of course, your work that you're doing and helping people understand, is how does someone go from in the field, as we might say, to in the home office? I couldn't do it, man. I couldn't give up the freedoms and the opportunities I have to reach and touch people in this arena, what I'm doing now, to go like work in that big mutual home office. So first off, help me understand what the heck is wrong with you.
Well, it took me a long time to figure out what was wrong with me, and I've made that correction, but it's safety. It's, at that time in my life, I loved the product. I loved what whole life insurance did. I really wanted to be a technician in the space. And I found that advisors in my firm were leaning on me for some of that expertise and some of that creativity. So, for me, it was just really digging into the product and being in a supporting role. But really the motivation was to move into it's a sales role within the home office called wholesaler, where you get to be out in front of advisors, telling the story, talking about the product, and being that expert and that touch point. So I don't know, at a low point in my career, I said I could use some of that safety and certainty. And, I think when it came full circle, I realized that the field was probably the place to be.
Very good. Okay, so you've got a PhD now. On the academic side, you have studied, you have learned, you have done all the tests of yesteryear. You predict things about the future in something as ominous for a lot of people as retirement planning. They don't know what to do. They don't know how to do it. But at the same time, everyone worries about this. I've never heard of an academic in this area. So help us understand your educational background and prove to us for just 1 second what I know, but prove to my people what we're going to talk about in some of your writings and your works, man. How do you get an academic degree in this?
Honestly, I spent about 100 nights a year in a hotel for almost a decade. And during that process, I was always trying to better myself, which is where all the academic degrees came from. I just kept taking a course at a time, chipping away at it. And a big part of it was what I struggled with early in my career is there's so many people in the financial planning space that say whole life is bad. Whole life is a bad investment. Whole life is a bad place for your money. You're better off buying term and investing the difference or doing all this other stuff. To the point where I started to say, am I just a good salesperson? Is this just a good talk track, or does this stuff actually make sense? So along the way, I got tied into the American college, which is very much the industry, the industry's college, if you will, for financial services, and got enamored by the study of retirement income planning under Wade Pfau. Wade Pfau is probably the most prolific author in our space in terms of retirement income studies. The whole time I started to think, I'm listening to all of this literature and saying, yeah, but nobody is talking about participating whole life insurance. Dividend paying participating whole life insurance by some of the big mutuals out there. and millions and tens of millions of people own this stuff. This is not some obscure asset class. So it got me wondering, is it just overlooked or is it a bad idea? And as I did a lot of these studies, I realized it's just completely overlooked. It's overlooked for a number of different reasons. But as I started to dig into it, my dissertation in the process was whole life as a fixed income alternative in retirement, essentially bond alternative. What would that have looked like historically, and what might it look like going forward based on interest rates? And the results were really eye-opening, to the point where I firmly believe now, after all that this is probably the most supportive environment for whole life insurance in about 80 years, meaning that it's probably the best environment for consumers to buy into it because of what could happen going forward with interest rates. And that was a big reason I wanted to come back out and start talking to advisors and their clients, in a more approachable way, and just be an objective third-party voice that's done the work, talking about why this stuff makes so much sense.
Love it, man. So when you decided to write this book right here, Permission to Spend, Maximize Your Retirement with the Best Kept Secret in Personal Finance, did you think that people would be excited to read this? Now, normally, historically, I'm walking across the bookshelf, I'm in the financial section, or I'm thinking about my life as a 39-year-old today, and I'm like, this ain't my book. But I read it, and I loved it. So you get raving reviews and an endorsement from me, whoever out there cares. But, how many people are really interested in learning about this or understanding what you've got going on, Who's the audience for a book like this?
I think the audience is probably a little bit older than you. I'm talking about the pre-retirees who are getting toward retirement. Yeah, honestly, the people don't know that they need this book, because we've all been taught how to accumulate money. If you've studied at all, you know that you need to save enough money, and you need to have stocks and bonds, and it's going to compound over time, and you're going to diversify your assets, and you're going to dollar cost average, which means put money in on a consistent basis every month. All that stuff. We've all kind of been taught that along the way if we've paid any attention to personal finance, but all that stops at retirement when you're done working. That's theoretically, and there's almost no discussion out there in any of these books that are out in personal finance about how does the money come out, right? What is your strategy to effectively take the money out, maximize how much you spend during your lifetime relative to any legacy goals that you have for your children, church, charity, or anything like that. So that's really where the book comes in. Is it's not so much, it does talk about retirement income or retirement planning 101, basically how to accumulate some money effectively, but really the talk is about how does the money come out. So beginning with the end in mind. And that's the struggle. I think if it's just sitting on a bookshelf, you might walk past it. But what I'm trying to do is educate people that there is this problem that you will be afraid to spend. And here's what you do about it ahead of time.
Love it. Okay. Well, you mentioned a couple of ways that we are going to experience risk in our retirement years. And those three in the book are the economic risk, endurance risk, and the expense risks. So help paint the picture for guys who are probably our age or generation or maybe younger for just 1 second, and helping them understand these three risks. What does that mean? I think the average about to retire or retiree understands these. But let's paint the picture for someone who's not yet retiring and they've just started to think about kids, family, maybe a second, third career choice, and they're not yet understanding what these three economic, endurance, and expense risks will be guaranteed if they live long enough.
Yeah, so the very, very high level economic risk is the markets. When you're investing and saving in your younger years, you have your 401k or your retirement accounts, and they're going up and down because you're investing in volatile assets, stocks and bonds. And that's okay, because when they go down, guess what? They're on sale. You should put more money in. It's buy the dip. That whole philosophy works really well on the way up. At retirement, right before or right after, if you see a market crash, it can dramatically impact your retirement. In fact, imagine showing up at retirement with $1 million and then all of a sudden it's worth $500,000 because of a big market crash. Now what? Are you going to take another $100,000 off and then spend it? Heck no. You're going to be afraid. You might even go back to work. So having that in mind, that economic risk is huge. And you can still be exposed to risk if you plan ahead and have some assets that are strategic assets that you can tap into, regardless of what the market's doing. Endurance risk is basically longevity. You might live a very long time. It is very common for a 65-year-old healthy individual to make it to 95 these days. And with medical advances, it could be 105 or 115 by the time you and I get to those advanced ages. People are living longer and longer. So how do you make your nest egg, however big that is, last maybe longer than your working years in retirement? That's a very big deal. So living a very long time is something to be planned for as well. And then there's the expense risk. And really what this is most of the time we're talking about long-term care. People don't realize that if you require expensive ongoing medical care, the kind of home health aid stuff or nursing home type care, there's no medical plan out there that covers any of that. Your Medicare and most insurance plans, they cover acute needs for care, but not ongoing. And these costs can be in the hundreds of thousands. The biggest claims out there, I think, are measured in the millions for individuals. So that can wipe a person out, or at the very least, make retirement very difficult. So tackling some of those risks ahead of time, it's just like anything else in life. You can tackle those risks once you're at retirement, but generally speaking in life, it's better to be proactive than reactive. So if you can proactively plan for those during younger years when you're less of a risk, you can really get ahead of the game.
I like it. So you insinuate and kind of give us an implication here that you can buy money. You can buy money utilizing this product that's always been around, kind of out there for everybody. And in the book, you don't get to that product right away. You don't really tell us what it is. You help us introduce us to the problems, and you find us where we are. I think most people relate to that. But why do you say that this product, this asset class, is the best boring money that you can buy?
So in any good asset allocation, you're going to have a variety of assets, some very risky that go up and down a lot. But generally speaking, when you have a lot of risk, things are going to do better, right? But you need to be able to have assets that you can tap into during Great Depression style crashes so that you can stay invested, maybe even add more money and stay the course. That's where all great fortunes in markets have been made, is when there's blood in the streets, if you will, and investors taking action. When you look at whole life insurance, the interesting thing is if you think about the economics behind whole life insurance. So people have called whole life insurance an asset class. I kind of reject that. It's not an asset class. It's a life insurance contract. But the performance of a dividend paying whole life insurance contract is backed by a portfolio of assets, largely long-term corporate bonds, mortgages, other investments, subsidiaries of these big mutual companies, treasuries, but typically very safe stuff. So bond-like vehicles that are paying these big companies interest. But that portfolio, if you will, is going up and down in value. Why whole life insurance is such a great asset is the insurance company, through the life insurance contract, guarantees that those cash values go up every single year. The only question is how fast. Typically, if you buy $1 million whole life policy by age 100 or sometime around then, you're going to have $1 million in cash value guaranteed. That's how they build the product. And then it'll probably be 2 or 3 million or more, depending on how dividends are paid out and compounded over time based on the performance of that general investment account. But it's always rising every single year. The only question is how fast. So if you really think about it, you're essentially participating in the profitability of that general investment account of volatile assets. But through the life insurance contract, you've been indemnified. They've guaranteed away all of that risk, right? So you're getting performance without the risk. And this is frankly what they pay the quants, the multi-million-dollar salaries on Wall Street to figure out. How do you get a better risk-adjusted return? Or a Sharpe ratio is what they use. How do you, for the same level of risk, get outsized returns? You're not going to get that with whole life insurance. We're not promising outsized returns. But how do you, for the similar level of return of other fixed income vehicles, take less risk? And that's where the insurance company, through risk pooling, has done that. So I jokingly say, not so jokingly, I'm very serious about it. I call whole life the best boring money you can buy, because we all need boring stuff in our portfolio. So even during the dark days in the market, we have money to tap into, or in better scenarios, maybe money that we can be opportunistic with and buy things when they're low, and when things are on sale. And whole life insurance, because of those economics, and really also on top of that, the tax advantages that are afforded it, make it probably, in my opinion, the best boring that money can buy.
I love it. So if I had to ask this kind of off the cuff, what would be the second best, the third best? I hear about other products out there that are coming from insurance companies quite often. You haven't mentioned other products that they have, and they have several, but there are certain things a lot of people out there are getting wind of because of social media, because of the hype around the information age. Other insurance products, or maybe completely different things, but those are always kind of tied to investment. And so we know that there's volatility. But what is the second, third best? And what are your opinions about other products from insurance companies?
That's a great question. I mean, I think that there's such a huge number of investments that you can make. Some people view real estate as extremely boring and conservative and riskless, but we know that's probably not the case. The insurance companies will put out multi-year guaranteed annuities. That's a very popular one right now, where you can buy basically a fixed annuity where you'll get 3, 4, 5%. It's tied to indexes, but they've put guardrails around how much you can lose and usually some caps on how much you can gain. So it's a way to get a little bit of exposure, but still have guardrails around that. Those are very popular and they're tax advantaged. At the end of the day, they're not tax free like life insurance, but those are tax advantaged. I don't have a great answer for you. Honestly, every client's going to be different. You can put cash in the bank. That's probably the lowest return, highest level of safety to a certain degree. But why do that when you have similar levels of risk out there, but much better returns and tax advantages than you would have. So a lot of it's mindset, I think.
All right. Totally fine. No wrong answers here. Just given that one came to me off the top of my head. You kind of start your story off in the beginning, telling your personal connection to why you started to think this way, kind of as a younger man starting off in business. And that personal story involves loss that you've had in your nuclear family. And I think similarly, having loss as a child in one of my parents passing away, my dad died when I was a kid. I think that made my mindset kind of shift a little differently. So what is it that people need to think about and understand when they're young? Maybe you and I both have a similar catalyst that kind of got us thinking a little bit differently. But tell us a little bit about that story and why most people maybe are just missing this in their younger years and their formative years of working. They're just missing out on what's going to happen later.
Yeah, I mean, I think the first words in my book are "You will be afraid to spend," and I saw this early on in my career working with retirees. People think that financial planning is math, and it's not. I mean, you can literally pull out calculators online and never talk to a human being and do financial planning in that regard. Really, financial planning is about how you're going to feel and the emotions that come along the way. And that's really what a good advisor takes you through. Telling you about I'll just share my story quickly. My mom passed away when I was 25 years old. And I think she was in her early 50s. She was in her early 50s at that time. And I was early on in my career in financial planning. And, I gotten very good at doing the math and helping people say that you need this many millions to retire on based on the financial goals that you said. And all you got to do is save, live below your means, put it off to down the road, basically, struggle today, essentially sacrifice today, so that someday when you retire, you'll reach that financial promised land, and then you can go spend all those assets, later on in life. And first of all, that is not guaranteed, right? You're not actually guaranteed to make it to retirement. So there's probably a balance of saving and enjoyment. But what really bugged me is when I started to dig into study of retirement income planning. There's something called the 4% rule, and it's hard to believe it was 30 years ago that was actually created. But that 4% rule basically was an academic looking at historical return patterns over time. And it was at a time when interest rates had started to fall to a degree where you couldn't just live off interest anymore. Mm-hmm. Traditionally in the 80s, you could just buy CDs and live off the interest. It was the interest when interest rates were 10%, that was fine. So that study became very popular as interest rates fell into the low single digits, and you couldn't do that anymore. And what he basically found was that in the worst case scenario over the last 100 years, you could have started with, call it $1 million, taken 4% of that in the first year, $40,000, and then increased it with actual inflation every single year, and spent your last dollar on the last day of a 30-year period. So as long as 30 years is your time horizon in retirement, 4% was historically safe in all environments. That's really where that came from. Modern studies based on a number of different factors that didn't factor in fees, it didn't factor in changing interest rate environments. A lot of the academics will tell you it's as low as 3%. Some even say lower. I have a hard time believing that. But regardless, that's not a lot of money. I mean, even at 4% on $1 million balance, that's less than $100 a day after tax. That's not a lot of money to be living on. So for me, that's pathetic, because in most cases, really 99% of the time, all other cases, you could have spent a lot more. So if you're living to 4%, you're essentially underspending, underenjoying what you've spent decades accumulating, and compounding money inside of probably horrible tax environments for legacy planning. It's going to pass to the next generation. So this puzzle came to mind. I said, how do we help retirees shift income to the earlier years in retirement when they're healthiest and most capable of enjoying it? And again, longevity is not guaranteed. They may only have 10 or 15 good years to really spend and enjoy that and share that with their family. So that's really what got me enamored with this whole concept of using insurance to shift the risk. Because if you think about it, if you have however many millions you've saved or whatever your number is in retirement, and you're living to that worst case scenario, you're essentially acting like your own insurance company. You're hoarding capital just in case an unlikely event happens, when in most of the time those horrible, bad, unlikely events don't happen. And then when are you going to feel comfortable saying, they didn't happen, now I'm free to spend? 75, 85, 95? And what do typical 85 and 95-year-olds look like? They don't want to travel the world anymore. They may be physically incapable of traveling the world. They probably aren't golfing anymore. Just think of all the things that retirees may do. So I got very fascinated with the use of actuarial science, annuities, life insurance, risk pooling, essentially shifting the risk elsewhere so that you can spend and enjoy that which you've spent a lifetime accumulating. And the results were such that, these products don't necessarily make you wealthier, but they make you feel a lot better about what you're doing, and they give you that freedom and permission to spend, which is why the book is titled that.
Well, if they do give us that freedom and make us feel better, I might argue that is where our wealth comes from, right? We've got that mental, physical, and emotional well-being because we do have that permission to spend. I love it. At this time, ladies and gentlemen, switching gears to our fan follow of the week. What's up out there on YouTube? AD Johnson 2083. We see you out there. Appreciate you following along to our storytelling and our saga as we help you crack the code to cash flow. And we hope that you drop us a line, leave us a comment or question, and we'll help you get your stuff answered as you want to save and spend at the exact same time. Coming back here to Dr. Tom Wall, we are talking about Permission to Spend, his book here that says Maximizing Your Retirement with the Best Kept Secret in Personal Finance. That's the next question I have for you, Dr. Wall. I read this on a plane just a couple of weeks ago. Loved it. I thought, man, retirement and academic, this guy's going to be boring, but since I met him, I'll go ahead and read it. And I was blown away. I loved it. I love what you're doing and helping the regular person understand this, right? We all are experiencing work and the future. And we're trying to figure out how we marry those two up, right? I got to work today. I got to spend money. I got to save money. I got to think about the long-term challenges and the long-term opportunities that I have too, as well as my goals and dreams. But why in the world is whole life insurance? Why is it a secret? Why is it that so many of us have gotten sucked into the noise of other things and we don't understand it? Or even crazier, we argue against it, even though we don't know. Why is that?
It's a great question. You actually just said some of the answers right there in the question. I think there's a lot of misinformation out there. First of all, the thing with participating, and by participating, I mean dividend paying whole life insurance, is it's an opaque fee structure. And what I mean by that is you can't see the fees. You can't see any of the costs involved in it. So a lot of the financial world struggles with that. Is I'm going to pay premiums into something. I'm going to make contributions into something, and I can't see the math on what's happening with my money. But that's actually a good thing. The fact that it's all bundled together, it's all based on the guarantees. But I'll tell you where I'm coming from that. So first of all, there's a lot of misinformation out there. There's a lot of people that say, don't buy this, don't do this. They got hurt back in the day because they talked to some unscrupulous agent who sold them the wrong thing, or something like that. Or maybe their goals didn't align with what they should own. But a big part of it is that it's not marketed well. Even the big companies that do this well, when you think about these products, you can pay a premium dollar into it. You can make a contribution. And because of the tax advantages afforded to permanent life insurance, interest will kick in, dividends will be paid, that will compound. You will have more money in that death benefit eventually than you paid in. So one way or another, you will multiply your money by many times over the course of your life, pass it to the next generation, and not owe the IRS a dime. That is really, really good, favorable tax treatment. And when you couple it with what I just said, if you can actually have a better risk profile, it can be really attractive. I mean, there are very wealthy people putting a lot of money into this as an alternate asset in their portfolios. So it took me a long time being in the business. And I've been in the business 20 years in a variety of different roles. One of those roles was actually working very closely with marketing and actuaries building these products. And I remember asking some tough questions as I'm trying to put some marketing concepts together and say, why am I not allowed to say these things? Why can't I talk about how the money comes in and out and how you can use it as an alternate asset? And why can't I say these words? And it's not that you're legally prohibited from saying these words. They're afraid of over marketing this as an investment, because it's not. It's an insurance contract, right? I just said it's not an asset class. It's an insurance contract. And a lot of advisors that aren't educated very well do that. They kind of say the wrong things. All you got to do is go online and look at other people's, TikTok channels and things like that. There's a lot of crazy stuff being said out there that frankly isn't true half the time. And they're afraid of it. So there's these companies, the legal departments, they don't really market it all that much. Even though millions of people own it, they don't market it for its accumulation aspects. It's marketed as life insurance first. Stuff is, oh, by the way. But for the right client, particularly wealthier clients, it can be a really phenomenal way to accumulate money, very conservatively, very consistently, oftentimes guaranteed. With tax advantages you simply can't get elsewhere on like assets. So that's why it's the best kept secret. I think a lot of people just misunderstand that. It's always, this is why I love Caleb's book. It was the And Asset Mastermind we went to. A lot of the world, most of the world, and I can tell you this, having been an advisor sitting across the table from clients, they're always saying, what's the best place for my money? As if option A, or option B, I have to choose one of those. Whereas it doesn't have to be that way. Life insurance can be the and asset. It can be life insurance and other stuff. It's because it's so safe, conservative, and tax advantage, you can go shoot for the stars with your real estate investments or business interests or equities or things like that. So that was a long-winded answer to your question, but I think it's the best kept secret because it's under marketed for the great things that it can do on an accumulation standpoint.
Love it, my friend. Appreciate you coming on this podcast to have this conversation. We want to make sure you are not the best kept secret, that's for sure, or this book. So where can we find you next, and how do we follow and get our read and our copy in?
Well, you can get the book on Amazon in all formats. Obviously, that's the easy one. permissiontospend.com. You can find me online. My handle is generally Tom Wall Talks on the social media channels as I continue to build those out, or TomWallTalks.com has got my bio and other ways to connect with me there.
So, all right. As we close out 2023 and go into the future, where are we going to find you next, and how are you building your business?
Well, I'm always on a stage talking to advisors. That's always been my sweet spot. I love sharing the story with advisors. And really, this book is my first work toward the consumer side to help advisors have something that they can give to their clients. So I think you'll continue to see those resources built out. I have no doubt I'll be publishing more books along the way as I try to give the advisor community more and more resources to share what I don't just believe is the best kept secret. I know is the best kept secret in our space. For folks that are trying to responsibly grow wealth and give themselves opportunities that they may not have had with the traditional models.
Love it. Well, Tom, appreciate you being on our channel. Would love to do more collabs with you in the future. I think there's opportunities for so many people in our space at the Cash Compound to hear you speak and to understand your mission to help people have that, financially sound future that we can count on. And we can have that permission to spend in retirement, man. So thanks so much for joining us on our little chat today in our podcast. And we'll catch you in the future next time. If you're willing to have us, we'd love to have you, man.
No doubt. It's been great getting to know you. Thanks for having me on.